Most traders see stop losses as mere numbers on a chart, a form of protection. But Richard Wyckoff, one of the greatest market minds of the 20th century, saw something deeper. To him, a stop loss wasn't just a tool. It was a measure of discipline, a way to survive the market's chaos, and the ultimate test of a trader's character. Today, you're about to discover Wyckoff's secret rules for placing stop losses. Rules that not only shape the markets of the past, but can transform how you trade today. Before we dive in, make sure to subscribe, hit that like button, share this video, and comment where in the world you're watching from, because the lessons you're about to learn are universal, across any market, any era. In the early 1900s, Richard Wyckoff walked the floors of the New York Stock Exchange. Amid the roar of brokers shouting orders, the smell of cigar smoke hanging in the air, and the frenzy of traders chasing every tick, Wyckoff developed a method to read the market like a living organism. He noticed patterns others ignored: accumulation phases, distribution phases, and the subtle ways large operators manipulated price. But one principle stood above all others: stop-loss discipline. Wyckoff's stops were never arbitrary. They were meticulously calculated, tied to market structure and the psychology of the masses. He often said, "You must protect your ability to trade before you attempt to profit." For him, the stop-loss was less about loss prevention and more about ensuring survival in a battlefield dominated by fear and greed. Fast forward to today. Modern traders face a very different battlefield: digital screens, instant execution, cryptocurrencies, leveraged instruments. But the core human emotions, fear, hope, panic, and greed, remain unchanged. Take Bob, a mid-20s trader working from his cozy home office. 3 monitors glow with candlestick charts. Coffee in hand, he watches a tech stock breakout after earnings. His instinct is to widen the stop, hoping the trend continues. The same psychological trap Wyckoff warned against over a century ago. Bob remembers Wyckoff's rule: never let hope dictate your stop-loss. He examines the chart structure, identifies recent support, and positions his stop strategically, beyond normal volatility, but close enough to prevent catastrophic loss. This is Wyckoff's timeless lesson applied in the modern age. The stop-loss is not fear, it's calculated discipline. Wyckoff also emphasized context over price. Stops aren't numbers plucked from thin air. They're dictated by price behavior, market structure, and the natural rhythm of supply and demand. Today's traders often ignore this, setting stops too tight or too wide based on gut feelings or social media hype. Bob, applying Wyckoff's method, studies the accumulation phase, maps the support zone, and sets his stop just below it. This single act, blending historical insight with modern application, distinguishes him from the average trader. Another cornerstone of Wyckoff's approach was position sizing in alignment with stop-loss placement. A well-placed stop is meaningless if your position risks too much of your account. In Wyckoff's time, operators knew that one wrong trade could wipe out months of gains. Today, Bob applies the same logic. He calculates risk first, then sets the stop. He respects the principle: the stop dictates the risk, not your desire to chase a trend. Timing was equally critical. Wyckoff noticed human behavior, creates predictable patterns across different markets and time frames. His stops were never guesses. They were informed by previous swing points, volatility, and structure. Bob mirrors this today by observing ATR, average true range, prior swing highs/lows, and volatility spikes to determine optimal stop placement. The result is disciplined exits and preserved capital, the very essence of Wyckoff's teachings. Here's a truth Wyckoff drilled into every student: the market doesn't care about your stop loss. It exists to protect you, to enforce discipline, and to preserve your ability to trade another day. Bob experiences this firsthand when a sudden crypto spike triggers his stop. Emotionally, it stings, but strategically, he survives. Tomorrow, he can trade again with a clear mind. In both historical and modern contexts, Wyckoff's principle is clear. Trading isn't about predicting every move. It's about preparing your mind, mastering fear, and controlling what you can control. The market's chaos is eternal, but disciplined stop-loss placement is timeless. Before we continue, remember, if you haven't subscribed, click that button. Like this video, share it with someone struggling to control emotions in trading, and comment where you're watching from. Wyckoff's rules transcend time. Whether you're trading stocks in 1920s New York or cryptocurrencies today, these lessons hold. The moment Richard Wyckoff stepped onto the trading floor, he saw the chaos others considered normal. Brokers shouting, tickers flashing, prices swinging wildly. It all looked like madness to the untrained eye. But Wyckoff understood something few ever realized. Behind every frantic move was a story, a pattern, a rhythm. And hidden within that rhythm was the secret to where to place your stop losses. Wyckoff's first rule was deceptively simple. Place your stop loss where it validates or invalidates your trade premise. In other words, your stop isn't arbitrary. It's tied to your reason for entering the market. If the trade premise fails, the stop triggers, protecting your capital. If it holds, you remain in the trade with confidence. Fast forward to today. Bob is trading a tech stock showing strong post-earnings momentum. Many traders panic when the price dips slightly after the spike, moving their stops closer in fear of losing gains. Bob, however, remembers Wyckoff's rule. He sets his stop just below a recent accumulation phase, the same principle Wyckoff applied decades ago. If the market invalidates his premise, he exits calmly. If it holds, he stays in, undistracted by the noise. This disciplined approach keeps him aligned with both the market and Wyckoff's timeless teachings. Wyckoff's second rule: always account for normal market noise. Markets move in waves, pulses, and retracements. Stops that are too tight are punished by normal volatility. Stops that are too wide invite unnecessary risk. Wyckoff studied price behavior relentlessly to determine the right distance for stops, one that accommodates the natural fluctuations without jeopardizing the trader's capital. Bob applies this in the modern market by using volatility indicators like ATR, average true range, combined with historical swing points. On a volatile cryptocurrency, for instance, he doesn't panic when a sudden 3% move hits his position. He knows his stop is beyond normal noise, reflecting calculated discipline, not fear. Wyckoff's principle is alive and well. A stop should be strategic, not emotional. The third rule is perhaps the most psychologically profound. Your stop loss is as much about training the mind as it is about protecting money. Wyckoff understood that traders often fail because they lack emotional control. A perfectly placed stop only works if the trader respects it. Many historical operators, including Wyckoff's contemporaries, would frequently adjust stops based on hope, greed, or panic. Wyckoff forbade this. A stop, once set, is a commitment, a contract with yourself to survive another day. Modern traders who ignore this principle fall into the same trap. Bob once saw a stock dip close to his stop during a spike. The urge to move the stop and wait it out was strong. He remembered Wyckoff's lesson. Respect the stop, respect the market. He left it in place. When the market rebounded, he not only saved his capital but strengthened his psychological resilience. This is the bridge between historical insight and modern application, a lesson that transcends eras. Wyckoff's fourth rule is practical and tactical. Place stops based on structure, not emotion. Support and resistance levels, accumulation/distribution phases, trend lines, and volume patterns dictate stop placement. Historical charts analyzed by Wyckoff show how operators would trap retail traders in distribution phases, only for the price to reverse violently. The stop loss, strategically placed beyond the manipulative structures, was their shield. Today, Bob applies this by studying modern charts on TradingView. He identifies areas where retail traders are likely to panic, areas of liquidity traps or false breakouts, and positions his stops beyond these zones. This tactical application of Wyckoff's rule ensures that he doesn't get shaken out by predictable market manipulations, proving that structural discipline is timeless. Wyckoff's fifth rule focuses on risk-to-reward alignment with stop-loss placement. A stop is meaningless without proper position sizing. Historical records show traders who mastered Wyckoff's principles risked only a small fraction of their accounts relative to the stop's distance. This ensured survival even during adverse market moves. In the modern context, Bob calculates the exact dollar risk based on his account size and the stop distance. He doesn't over-leverage. He doesn't go big because a trend feels strong. By combining historical wisdom with contemporary risk management, Bob ensures every trade preserves his ability to trade tomorrow, a principle Wyckoff drilled into every student. The sixth rule bridges psychology and action. Use stops to remove emotion from trading decisions. Wyckoff observed that markets prey on indecision. Traders second-guess, move stops, or exit too early because emotions cloud judgment. Historical journals from Wyckoff's time recount traders being trapped by hope, moving stops wider, and losing entire fortunes. Bob experiences this same dynamic today in highly volatile instruments like crypto and tech stocks. By predetermining stops using Wyckoff's principles, structure, volatility, and premise validation, he removes the emotional element. The stop becomes a tool of discipline, not fear. And when the stop triggers, he exits without regret, knowing he is following a tested system rather than reacting to chaos. Finally, Wyckoff's seventh rule, one of the most misunderstood. A stop loss is not a loss, it is a transfer of opportunity. Historically, Wyckoff trained his students to see every triggered stop as freeing capital for better trades. Losing a trade is not failure. It is an opportunity to reset, learn, and re-engage with the market under favorable conditions. Bob embodies this mindset today. When his stop is hit during a volatile spike, he doesn't sulk or revenge trade. Instead, he studies what went right and wrong, analyzes structural patterns, and prepares for the next opportunity. This historical principle, seeing stops as liberators, not punishers, allows modern traders to maintain composure, stay disciplined, and consistently engage the market strategically. At this point, you may be wondering, how can such principles, developed over 100 years ago, still apply in today's fast-moving markets? The answer is simple. Human psychology hasn't changed. Fear, hope, greed, and panic drive price action then as now. Wyckoff's stop-loss rules are essentially lessons in mastering human emotion. They are the blueprint for trading discipline that transcends time and technology. Before we move into Section 3, which will dive even deeper into emotional mastery and modern protocols for stop-loss management, remember, if you haven't already, subscribe, hit like, share this video, and comment where you're watching from. These principles are as relevant for someone trading Tesla today as they were for traders in Wyckoff's era. Discipline is universal. The market, in essence, has always been a mirror of human emotion. From the bustling floors of the New York Stock Exchange in Richard Wyckoff's era to the quiet home offices of modern-day traders, fear and greed pulse through every tick, every candlestick, every trend. Wyckoff understood this truth better than anyone. He realized that discipline and stop-loss placement was not merely a technical skill. It was a test of the mind. Wyckoff often told his students, "The market is indifferent to your hopes and fears, but it will test them relentlessly." Every trader, regardless of experience, faces this challenge. The first psychological hurdle is fear, the fear of losing, the fear of being wrong. In Wyckoff's time, a wrong trade could wipe out a week's worth of gains. Today, a single volatile swing in cryptocurrency or a high-leverage stock position can do the same. The instinctive reaction is often to move the stop, widen it, or hedge impulsively, all emotional responses that compromise discipline. Enter modern trader Bob again. Bob faces a sudden drop in a tech stock he bought after earnings. A wave of fear washes over him. He's tempted to move his stop-loss further down, rationalizing, "It's just a dip, the trend will continue." But Wyckoff's teachings echo in his mind. Fear is not a guide, structure is. Bob looks at the chart, verifies his premise, and leaves the stop untouched. The market dips, triggers his stop, and exits him cleanly. Emotionally, it stings, but strategically, he survives and retains the ability to trade again tomorrow. This is Wyckoff's timeless principle in action. Stop-loss discipline is emotional mastery. The second psychological element Wyckoff addressed was hope. Traders often hope their analysis is correct, even when the market signals otherwise. Wyckoff observed that hope is a dangerous driver, often leading to larger-than-necessary losses. In his era, operators would exploit hope by creating distribution phases that trapped optimistic retail traders. The stop-loss, correctly placed, served as a protective boundary, preventing the trader from chasing hope into ruin. Modern markets are no different. Consider a cryptocurrency trader watching Bitcoin spike after an unexpected news event. Retail traders, fueled by hope, move stops wider and by more, convinced the trend will continue indefinitely. Bob, however, calculates the stop based on structure and volatility. When the price reverses, his position is protected. The difference is profound. Hope can kill your account. Discipline preserves it. Next is greed, another timeless force Wyckoff studied closely. Greed tempts traders to hold positions too long, squeeze profits aggressively, and constantly adjust stops to chase just one more win. Wyckoff warned that the market always punishes greed, often violently. A well-placed stop acts as a countermeasure, a disciplined boundary that keeps you in the game, not overexposed to the whims of fortune. Bob experiences this in modern trading when a stock surges far beyond his target. The temptation to trail the stop aggressively and extract every cent is strong. But he remembers Wyckoff's lesson. The stop loss is not about squeezing maximum profit, it's about preserving your ability to trade tomorrow. By letting the stop do its job, he secures what he already won and frees himself from the emotional trap of greed. Wyckoff also emphasized patience and detachment as core components of stop-loss discipline. Many traders react to every tick, chart pattern, or rumor. Wyckoff taught that trading is not a series of reactions, it's a strategic waiting game. In modern terms, this means letting your pre-planned stop execute without interference, even as your mind screams to act. Bob's modern example illustrates this beautifully. Trading a volatile technology stock, he sees a flash crash during market open, a move that would terrify most traders. Many would panic, adjusting stops or exiting early. Bob does nothing. His stop is calculated, respects structure and volatility, and is left untouched. The price recovers, confirming his premise, and he remains in the trade with composure. Wyckoff's century-old guidance, patience, detachment, and respect for your stop, proves its relevance in today's hyper-fast markets. The next layer is mental conditioning through repetition. Wyckoff trained his students to follow a disciplined process repeatedly until it became second nature. This is no different for modern traders. Bob practices stop-loss discipline on every trade, no matter the size. He predetermines stops, calculates risk, and commits emotionally to the rules. Over time, this repetition builds resilience, confidence, and consistency, psychological traits far more valuable than any indicator or chart pattern. Wyckoff also stressed seeing loss as a learning opportunity. He taught that a stop being hit is not a failure. It is a feedback mechanism. It signals that either your premise was wrong or that the market's structure changed. Historical records show Wyckoff guiding his students to embrace triggered stops as part of a larger learning cycle. Today, Bob applies this philosophy to every trade. When a stop triggers, he reviews the structure, identifies mistakes, and prepares for the next opportunity, without emotional baggage. Another modern psychological application is avoiding revenge trading. Wyckoff warned that emotions like anger or frustration after a stop triggers are dangerous. The average trader, historically and today, reacts impulsively, doubling down on a losing trade or chasing a price that already punished them. Bob adheres to Wyckoff's principle. A triggered stop is a signal to pause, analyze, and prepare, not react. By doing so, he converts emotional pain into disciplined action. Finally, the overarching lesson. Stop-loss discipline is the foundation of all trading psychology. Wyckoff knew that technical skills are useless without emotional mastery. Historical traders who followed this principle thrived. Those who ignored it perished. Today, Bob embodies the same principle. Modern markets may be faster, but human psychology remains unchanged. Discipline, emotional control, and respect for stop-losses determine who survives and who fails. Before we move to Section 4, which will break down modern stop-loss protocols, calculation methods, and actionable examples, remember to subscribe, like, share, and comment where you're watching from. Whether you're trading stocks, crypto, or futures, these psychological principles are the secret that connects Wyckoff's century-old wisdom with modern trading mastery. Richard Wyckoff's genius was not only in understanding the psychology of markets, but also in translating that understanding into precise, repeatable methods. He didn't rely on guesswork or intuition. Every stop-loss, every exit, every position was anchored in structure, risk, and observation. And while his tools were pen, paper, and tape machines, the principles behind them are directly applicable to today's digital, fast-moving markets. The first step Wyckoff emphasized was identifying the trade premise. A stop-loss is only meaningful if it aligns with the reason for entering the trade. Historically, Wyckoff's students would mark accumulation and distribution phases, key support and resistance levels, and volume patterns. These structural points dictated where stops should reside. In modern markets, Bob begins every trade the same way. For instance, he's trading a volatile tech stock breaking out after earnings. He identifies the premise. The breakout is supported by accumulation, strong volume, and a favorable market trend. He then asks, at what price would this premise be invalidated? The answer defines his stop. By linking stops to the trade premise rather than emotion, Bob ensures his exits are strategic, not reactive. Next comes volatility-based placement, a principle Wyckoff intuitively applied even before technical indicators existed. He observed historical price swings, typical retracements, and the average range of movements to prevent normal market fluctuations from triggering stops prematurely. Today, Bob uses the average true range (ATR) to quantify volatility. If a stock typically moves $2 per hour, he positions his stop beyond that natural range. This mirrors Wyckoff's methodology. He's translating structural observation into a numerical, modern protocol. Wyckoff also stressed position sizing in harmony with stop-loss placement. A wide stop requires a smaller position. A tight stop allows a larger one, maintaining consistent risk across trades. Bob follows this principle religiously. Before entering a trade, he calculates distance from entry to stop, maximum acceptable risk, e.g., 1 to 2% of his account. Position size equals max risk divided by stop distance. By doing this, every trade has a predefined, acceptable risk. This is Wyckoff's timeless risk discipline applied in modern markets, ensuring Bob's account can survive adverse moves without emotional chaos. Another key principle is placing stops beyond structural traps. Wyckoff studied accumulation and distribution to understand where retail traders were likely to panic. A well-placed stop sits just beyond these likely liquidity traps, preventing traders from being shaken out unnecessarily. Modern Bob applies the same logic. Before setting a stop, he scans for zones of previous panic selling, minor resistance levels, or algorithmic stop clusters. His stop sits safely beyond these points, giving the trade room to breathe while still protecting capital. Wyckoff also emphasized dynamic versus static stops. While a stop is initially placed at a logical level, Wyckoff taught students to trail stops in accordance with new structural highs or lows, but only if the market confirms the trend. The mistake most traders make is adjusting stops impulsively, driven by emotion. Bob mirrors this modern application. Once a breakout confirms a trend, he carefully moves his stop in line with new support levels, respecting structure, not fear. This ensures discipline and maximizes profit potential. Let's visualize a modern example. Bob trades a breakout in a tech stock. Entry at $150, initial stop below support at $145. The stock climbs to $160. Rather than panic or greed-driven adjustment, he trails the stop to $155, just below the new swing low, preserving profits while maintaining risk discipline. This mirrors Wyckoff's century-old principle. Let the structure guide your stop, not emotion. Wyckoff also stressed the importance of reviewing stops post-trade. Every triggered stop, every exit, provides critical feedback. Historical journals from his students reveal meticulous record-keeping. Why a stop triggered, what market structure changed, and how the premise aligned with results. Bob adopts the same practice today. Every day, he reviews triggered stops, compares them to structural patterns, and notes lessons learned. This continuous feedback loop strengthens discipline and improves decision-making, bridging historical methodology with modern analytical tools. One of the most overlooked rules Wyckoff taught is respect for the stop-loss as a psychological contract. Setting a stop is easy. Honoring it is hard. Wyckoff warned that moving stops based on fear, hope, or greed was a trap. Modern traders do this constantly, widening stops during panic or tightening them during uncertainty. Bob combats this by treating every stop as a non-negotiable rule, a contract with himself to maintain discipline. This simple yet profound psychological commitment is why Wyckoff's methods endure. Modern trading also offers tools Wyckoff never had: real-time charting, alerts, algorithmic execution. Bob sets his stops on TradingView with automatic alerts and execution triggers. But he does so guided by the same principles Wyckoff applied: structural levels, volatility, and premise validation. Technology amplifies discipline. It does not replace it. The timeless principle remains. The stop loss is the trader's shield, not the market's mercy. Wyckoff also advised considering correlated markets when placing stops. Historically, he observed that commodities, stocks, and bonds moved in interconnected cycles. Modern traders, especially in forex or crypto, see the same dynamics. Bitcoin's move often affects altcoins. Tech stock swings can correlate with NASDAQ futures. Bob integrates this into stop placement. If correlations indicate potential amplified volatility, he adjusts stop distance, not on whim, but based on structural analysis, staying faithful to Wyckoff's strategic logic. Finally, Wyckoff taught that every stop loss is an opportunity for learning and growth. Historical traders who mastered this principle thrived because they detached emotion from execution. Modern Bob applies this by journaling, reviewing triggered stops, and seeing each exit as feedback, not failure. This mindset transforms losses into tools for long-term success, aligning historical insight with modern psychological practice. Before we move into Section 5, which will consolidate Wyckoff's principles into a full modern trader's playbook, remember, if you haven't subscribed yet, hit that subscribe button, like this video, share it with someone who struggles with trading discipline, and comment where in the world you're watching from. Wyckoff's rules, though developed over a century ago, are just as powerful today, in any market, for any trader who chooses discipline over emotion. As we reach the final chapter of our journey into Richard Wyckoff's stop-loss secrets, it's important to realize one thing. The market doesn't care about your plans, your hopes, or your predictions. What matters is discipline, preparation, and execution. Wyckoff knew this over a century ago, and modern traders must internalize the same lesson. The stop-loss is not punishment. It is a lifeline, a teacher, and the ultimate tool for mastering trading discipline. Let's return to the bustling New York Stock Exchange of Wyckoff's time. Amid the chaos of brokers shouting, phones ringing, and ticker tape rolling, Wyckoff students carefully observed price action, volume, and structure. Their stops were calculated based on rationale, not emotion, and their positions sized to survive mistakes. Many historical traders failed because they ignored these rules, letting hope and greed dictate their exits. The few who respected Wyckoff's methodology thrived, not by predicting the market, but by controlling their risk and psychology. Today, traders like Bob apply these same principles in a modern context. His home office is a stark contrast to the NYSE floor. 3 monitors, real-time charts on TradingView, a cup of coffee, and an alert system that executes stops automatically. But beneath the technology, the core principles remain the same. Premise validation, structural placement, volatility awareness, risk sizing, and psychological discipline. Technology has made execution faster, but it cannot replace the timeless wisdom Wyckoff left behind. Here's how modern traders can turn Wyckoff's principles into a complete stop-loss playbook. Step 1. Define your trade premise. Every stop-loss starts with a clear reason for entry. Historical Wyckoff traders mapped accumulation phases, identified supply-demand zones, and studied volume patterns. Modern traders must do the same. Bob, for example, identifies a breakout in a tech stock supported by strong volume and favorable market conditions. He asks, at what point is this premise invalidated? The answer becomes the foundation of his stop placement. Step 2. Analyze market structure. Wyckoff emphasized stops must align with structural realities, not arbitrary numbers. In 1920s stocks or commodities, this meant support and resistance, swing highs and lows, or accumulation/distribution boundaries. For Bob, it's similar. He examines previous swing points, recent consolidations, and zones where retail traders are likely trapped. His stop sits beyond these structural traps, giving the trade breathing room while protecting his capital. Step 3. Incorporate volatility. Even Wyckoff knew markets had normal fluctuations. Stops too tight are doomed. Stops too wide invite unnecessary risk. Modern traders measure volatility using tools like ATR. Bob calculates the average movement over recent hours and places his stop beyond normal swings. This method transforms guesswork into science, exactly as Wyckoff did with meticulous observation a century ago. Step 4. Align position size with stop distance. A stop loss is meaningless if paired with an improper position size. Wyckoff's students understood this, risking only a small fraction of their capital relative to their stop. Bob calculates the risk per trade as a percentage of his account and derives position size accordingly. This ensures every trade is survivable, no matter the outcome. Step 5. Commit to discipline. Perhaps the hardest step is emotional obedience. Wyckoff's timeless advice. Respect the stop, or the market will teach you its lesson. Bob treats every stop as a non-negotiable contract. When triggered, he exits immediately without second-guessing, knowing this is a victory in discipline, even if it feels like a loss in the moment. Step 6. Trail stops strategically. Wyckoff allowed for adaptive stops, trailing them along structural highs or lows as the trade moves in favor. But he warned against impulsive adjustments driven by emotion. Modern Bob moves stops only when the market confirms a trend and new structural levels are established. This maximizes profits while preserving the safety net. Step 7. Review and learn from every triggered stop. Wyckoff stressed that each stop-loss event is feedback. Historical traders kept journals detailing why a stop triggered, structural lessons learned, and how their trade premise aligned with the market. Bob applies this daily. Every triggered stop is analyzed, lessons are recorded, and adjustments to future trades are made. This feedback loop creates long-term skill development, emotional resilience, and consistent profitability. Step 8. Respect the stop as opportunity, not failure. Perhaps Wyckoff's most profound lesson: a triggered stop is not a loss. It is a chance to preserve capital and prepare for the next opportunity. Modern traders must internalize this mindset. Bob experiences this every week. Each time a stop hits, he views it as freeing capital for better trades, reducing regret, and strengthening discipline. Step 9. Integrate correlated markets. Wyckoff observed that different markets moved in cycles. A misread correlation could amplify losses. Today, Bob studies correlated instruments, whether futures affecting stocks, crypto pairs, or tech indices, to anticipate volatility spikes and position his stops accordingly. This modern application reinforces Wyckoff's original insights on structural awareness. Step 10. Build a ritual around your stops. Wyckoff students trained their minds rigorously. They reviewed charts, planned trades, set stops, and adhered to them like a ritual. Modern traders can do the same. Bob journals, reviews historical charts, sets alerts, and automates stops. This ritual builds psychological discipline, making emotional control automatic rather than forced. By following these 10 steps, Wyckoff's stop-loss rules are transformed into a complete modern trader's playbook. History and modernity converge. The chaos of the NYSE floor and the volatility of today's tech and crypto markets share the same underlying truth. Human emotion drives price. Discipline, structure, and calculated stops are the constants that determine survival and success. As you internalize this playbook, remember, the stop-loss is your protector, your teacher, and your gateway to consistent trading. Every exit, every triggered stop, every review is an opportunity to grow, learn, and master your psychology. Before we close, a reminder. If you haven't yet subscribed to the channel, hit like, share this video with someone struggling to stay disciplined, and comment where in the world you're watching from. Wyckoff's century-old secrets, applied today, are your blueprint for trading mastery, in any market, in any era. Now, take what you've learned, define your premise, respect structure, measure volatility, size your positions, and commit to the stop. Practice, review, and adapt. This is the path from chaos to clarity, from fear to discipline, and from guessing to mastering the market. And remember, the stop-loss is not your enemy. It is the silent guardian of your trading life. Protect it, respect it, and the market becomes a playground, not a battlefield.